and we can get rolling. So thanks a lot, everyone. Thanks for joining. My name is Josh Payne. I'm a Director of Business here at Quantopian. And today we're going to be talking about earnings announcements. So we've got a bunch of guests here with me today in the recording closet at Quantopian Corporate Headquarters. We've got Seong Lee with me. We've got Dr. Jess Stauth dialing in from a mostly vacation trip out to San Francisco, and we've got Anju, CEO of EventVestor, on the line as well. So today, just in terms of the agenda, we'll start off with a conversation with Jess and Seong, where we can talk about the importance of earnings announcements, some of the work that Seong did, and how to use it, and then we'll close off the webinar. Or the second part will be we'll ask some questions of Anju just so he can help us understand where the data comes from and how EventVestor generates the data, so you guys can understand the data a little bit better. And then we can wrap up with questions. So as the questions hit you, feel free to throw them into that question pane, and we can try to cover them in the second half of the webinar. So with that, why don't we get started? So Jess, thanks for joining us from your vacation.
No problem. Anything for you guys.
Anything for the data. Anything for the data, Jess. So Jess, just for some of the newer listeners or sort of new folks to the community, can you describe what your role is here at Quantopian? What's your background, just so we know what you're all about?
Sure thing. So I've been, I think, working at Quantopian for about 2.5 years now. I think, like I was saying, my tenure might have started right around when Simon's did. I know we certainly talked in those really early days. My background is really originally in basic research. So started out in physics, interested in physics, did a PhD in biophysics and computational neuroscience at Berkeley. So I'm sort of back out visiting with some of my grad school friends actually this week. And in grad school, what I focused on was really looking at building predictive models around trying to figure out sort of how the brain works and how the brain translates, all this complicated input that it receives into some sensible output and action. So when I finished grad school and decided I didn't want to stay in sort of the academic sphere and was looking at interesting applied areas that had this type of, intensive analytical work and modeling and thinking about sort of lots of data trying to process, the financial sector, like a lot of people, drew my attention. So I moved from academia into the world of quant finance, initially working actually for a company in San Francisco called Starmine. So when we talk about earnings today, my prior life, when I started out as a quant, really spent almost all my time thinking about, a lot of my time initially thinking about earnings and how earnings announcements and information asymmetry move stock prices. So I worked at Starmine and Thomson Reuters as a quant researcher, and then also doing a little bit of customer-facing work and figuring out how a lot of the quant customers of Thomson Reuters used their data and analytics. And through that path, I met Foss when he was starting Quantopian, or he was maybe a year or so in, and I had moved to Boston, met him, and got really excited about the idea, right, that Quantopian was going to be able to address this really different set of quant users, the same institutional quants that I was used to working with before, but also, individuals who hadn't previously had access to this type of data or analytics or even really thought about investing as, a software problem or a quant problem. So that's a little bit of my background. At Quantopian, what I've ended up doing has varied a bit. So try to serve, as I always have in my old job, as kind of internal voice of the quant internally inside the company. So I try to help explain to yourself and the other folks on the product team what I think our users are trying to say when they're asking us what to build, basically try to give product feedback internally. And then really what's taken up most of my time in the last year is actually building a research team internally where we're looking at trying to develop selection strategies that operate on algorithms. So while an individual algorithm might think about how to select from every possible stock, let's say in the US market, what to buy and what to sell, once you have a universe of algorithms, which is what people are creating in the paper trading contest, creating on the forums, creating in their own accounts, once you've got sort of a big universe of algorithms, you can actually think about a portfolio construction problem that's one level up, that says, hey, how do I evaluate many, many different trading algorithms and decide which ones I think are outperforming and which ones I think are going to continue to outperform. And we're just in the infancy of starting to actually try to identify outperforming trading algorithms and allocating capital out of a prop trading account to those. So that's what I've been working on a lot. And when we dig into talking about earnings, one of the things, we have a small investment committee that helps advise me and look at strategies we're considering allocating to. And one of the big outstanding things that we've identified as sort of like known concerns or risks is that up until now, strategies people build on Quantopian may not very easily be able to be aware of events that are coming down the pipe. And one of the guys on my investment committee said to me, think of it like when I was saying, well, how important, we got to prioritize everything, we're a startup. He said, well, think of it like you're standing on the train tracks and you see a train approaching you. You can see its headlight. Are you going to want to move out of the way of that train if it's feasible, or are you just going to choose to stand there and let it come rushing onto you? And I was like, okay, that's a helpful analogy. So we really think that helping to get people access to data that tells them what's coming down the pipe for the stocks that are in their investment strategy is really important. And we also think it's important for us as we start to go from sort of proof of concept prop trading fund into the launch of Quantopian's hedge fund this year, thinking about events being fed into our algorithms and then our portfolio is something that we think is really important. And I know we're going to get into the details of that.
Yes, just let me ask sort of a follow-up question on that. So you know that an earnings announcement is coming, and maybe why shouldn't you want to be sort of in that stock when the earnings announcement comes in? Isn't there a good chance the stock's going to see a big jump, and your position's going to benefit from being in that stock when an earnings announcement occurs, and there's a pleasant surprise and off you go?
Yeah, so really the way I think of it is that there are many different types of quantitative investing strategies you might try to develop. And when I worked for Starmine, we did a lot of stuff where we actually looked at trying to predict and capitalize on earnings surprises, right? So just to kind of take a step back, for those of you who may be new to the finance world, corporate earnings is something that happens on a quarterly and annual basis where a company reports to the SEC, hey, here's how much money I made, here's how much money went out the door in terms of taxes or depreciation or one-time legal settlements, all sorts of fun stuff is hidden in that earnings announcement. There tends to be this basically really simple top-line number that people focus on, which is the earnings per share number. But of course, there's a lot of data rolled up inside that earnings announcement. And what will happen is all throughout the fiscal quarter, and each company reports the earnings on their own kind of calendar, which is annoying for quants. But so all through a fiscal quarter, there are many, many sell-side analysts that will be studying that company, and they might be listening to the company's guidance, and they might be trying to do their own analysis, and they're trying to predict, hey, at the end of this quarter, let's take Netflix, for example. At the end of this quarter, Netflix is going to report, and I'm going to, everybody will estimate what they think their earnings per share number is going to be. And so you'll commonly hear sort of this phraseology tossed around where people will say, well, the street expects Netflix to come in at X earnings per share dollars. So that's considered the consensus estimate, and there's a lot of research that shows that the consensus estimate does, to a large degree, actually anchor investor psychology. So people are sort of expecting a number. Now, when Netflix comes around and actually reports, they may report a number that's equal to that consensus number, and that would be called meeting expectations. They may report a number that's in excess of that, beat expectations, or they may report a number that's lower than that, miss expectations. And in the simplest way of sort of defining a feature space for a quant, you can actually build investment strategies around trying to predict whether a company is going to miss, meet, or beat their earnings announcements. And that's a great type of strategy. It does involve a lot of data crunching and a lot of overhead in terms of figuring out how to know for each company like where you are in their fiscal quarter and when the announcement is coming and sort of time all of that correctly. So there's certainly a lot of interesting upside in designing strategies to exploit earnings announcements, right? And that's something that I eventually think would be really interesting to see, more of that on Quantopian as we get more data. So that's one category, and you say, okay, that all sounds great. But what about for somebody that's trading, a pairs strategy or a price-driven strategy on Quantopian? Maybe it's a price-driven momentum strategy. Maybe it's mean reversion. If your strategy is not designed to incorporate and be capitalizing on information around earnings announcements, then what that means is it's actually completely ignorant of whether an earnings announcement is going to be likely to be a positive event for that stock, and that's sort of you have a predicted profit target or predicted excess returns, or whether your model, if your model has no information, it has no information whether it expects it to be good or bad, right? So, and it's actually very difficult, even when you're designing a strategy and ingesting all of the different earnings estimates and past earnings, and you've built an entire model to predict earnings estimates. Even in that case, we would report proudly stats of being able to call earnings surprises 70% of the time in sort of favorable conditions, very close ahead of the earnings announcement. So even when you're trying to make a prediction about whether a company is going to profit, in a window of, let's say, like 1 to 5 days or even a couple weeks after an earnings announcement, it's really difficult to do so. And if your model is not taking any of that stuff into account at all, then basically how would you expect it, to do better than chance? So you might say, okay, well, so it doesn't know anything about this earnings events, so it's going to basically perform at chance. So when an earnings announcement comes along, unbeknownst to my model, then that stock may pop, it may pop up, it may pop down. If I'm invested in sort of a stat arb strategy across many stocks, that's probably going to be a wash. And that's kind of true. So if you're trading an investment strategy that's price driven, but it's really trading many positions with very small exposure to each position, then your urgency around needing to know about events is a little bit lower. Still, for clean living and institutional quant level, you would want to know about that. But now think about the case where you have a lot higher position concentration, you have a smaller universe, your exposure to the names in your portfolio is much higher. So let's say you're trading a pair strategy, for example. Well, in a pair strategy, you've got, let's pretend in the simplest case and the most high position concentration case, you've got two stocks and you basically think that they're co-integrated, they should, over the long run, move together and be coupled. Well, if you're long one stock and short the other, and the earnings announcement comes out, and it is going to pop one of those stocks in one direction or the other, very likely that really is going to be an idiosyncratic risk event, or something that really is to do with that one name, which now really, at least in the short term, probably perturbs the co-integration pattern that your strategy has seen. And so really, to try to wrap up sort of the long-winded answer, the way I think about it is, if your strategy is not trying to capitalize on earnings events, then you're being exposed to risk by those earnings events that your model's not designed to handle. And the time when you want to be most concerned about that is when you have exposure to any one stock, because you can see, and we did see, my favorite example is always Netflix. They came out and reported numbers that actually, I believe, sort of beat their top line. So we saw after hours trading, oh wow, Netflix is up after hours, 7%, or I forget what the exact number was. Well then, lo and behold, analysts and investors dig into the details of the report a bit, and they said, well, are the earnings managed? Does the top line numbers look okay? But we're concerned about how stable is their growth? What are some of these longer term indicators? And in the next trading session the next day, the after hours gains disappeared, and I think the stock dropped 5 or 6%. So if you're trading Netflix with a price-driven strategy, and you're sort of looking at a trailing window that may not have included earning surprises for Netflix, that's going to introduce big discontinuity for your strategy. and you're going to see a lot of risk.
So there's a lot to unpack there. So I think the first thing that we learned there is that if your strategy is not sort of the underlying hypothesis is not sort of centered around earnings announcements, you're adding risk to your strategy. The risk increases, it sounds like, the greater the concentration of positions you have in your strategy. So if you're holding 500 positions or 200 or something, some large basket of stocks, the risk is less acute, but it's still there.
Exactly. Yeah. So it's like, think of if you've got, a 1% or less exposure to any one name, then as earnings season rolls around, you get a couple 10% gaps, right, up or down in those names. Well, that only moves your overall portfolio, right, like, several basis points. So yes, that's exactly right. The more names you hold, kind of the less exposed to single name risk that you are.
Gotcha. And in essence, these earnings announcements are a coin flip event for you, if you're holding those stocks. You're closer to gambling, it sounds like, than anything else, if your model doesn't account for the behavior around those earnings announcements.
Yeah, at a high level, that's how I think of it. Yes.
Awesome. So one thing with respect to risk, how are you, how does a quant measure that risk? Like, what's the measurement that they might use to understand that risk, or what's happening around those earnings announcements?
Yeah. So, risk is a, enormous topic and sort of field of expertise in quant finance and investing in general. Really, though, if you want to sort of break it down to its simplest level, the sort of simplest measure we have to look at risk is just trailing volatility of price. So you're looking at, let's say, what's happened to, a returns time series for a stock over the trailing, 1 year. The way that you think of risk at a very simple level could be just the volatility in that time series. So a statistical measure of dispersion, and we commonly use the standard deviation. So you can sort of picture, price time series where, every single day the price moves, very, very small amount, always up and to the right. That's sort of going to result in a time series of returns that have a very high Sharpe ratio or risk-adjusted returns with very low volatility, right? So the standard deviation of those points around some trend line, you would draw through it. If it's very, very, very small, you sort of consider that to be very low risk. Now, it's worth noting that there's a great example that I was reminded of the other day because a friend of mine pulled this figure from Nassim Taleb's Black Swan book. Showing a great counterexample to when volatility is a great measure of risk. So there's always counterexamples, and the one, and I'm sure people on this call will sort of have seen it, is this idea that picture the volatility and the future expectations that a turkey may have over the year about his weight gain or his quality of life in any given day. So there you've got something where the turkey has a great life for a very long time and gains a little bit of weight every day and sort of has this like happiness line that's like no volatility, no risk trend line up and to the right until Thanksgiving or until Christmas or until whatever event, in which all of a sudden he has like a discontinuity, a fat tail event. So now suddenly the turkey gets killed for dinner, and nothing about his prior experience in life would have led him to believe that, right? So when you think about like volatility being a good forward-looking predictor of risk, it's only as good as the autocorrelation in the volatility of a time series, right? And that is really where risk becomes an incredibly difficult thing to forecast because other events can come in and disrupt that. So that's sort of like a little long diatribe sidebar on like volatility, and how good it is as a measure of risk. It's kind of like not that great, but it's the best simple thing that we have.
Got it. With that warning in hand, I'm going to turn over to Seong here. Seong, you discovered a nice article that sort of explored the idea of volatility and earnings announcements. So tell us about that article. What did you find?
Yeah, so there was a study released by a couple of Stanford professors in 2015 that looked at the impact that earnings reports were having in stock prices from 1971 to 2011. And the idea behind the study being that with information so readily available in the world due to things like the internet and basically the internet, the impact of of earnings should have been decreased, should have decreased substantially.
Or they hypothesized
They
it.
hypothesized that it would. But actually, what they found was that over the years, and especially when the study cut off at 2011, earnings calls were having a greater impact on stock prices from 2001 to 2011 than they were back in the 1990s, the 80s, and the 70s. So it was really contradictory to their original hypothesis. And what I did was take that study and kind of extrapolate that forward from 2011 to 2015 and try to see if I could replicate the results. And what I found was that, yeah, we pretty much found the same thing that.
So I guess there's
Yeah.
sort of two competing hypotheses that these Stanford professors have. It's like, hey, there's the internet. The internet is like the greatest mechanism ever created by
Yeah.
humans for distributing information. So these arbitrary earnings announcements, every quarter will no longer mean as much, in
Yeah.
theory, because information is flowing more and more
Yeah.
information is flowing more freely. And then the counter argument, I guess, is which sort of held valid, is that yes, we're distributing information, but those earnings announcements actually now are getting distributed so effectively that they have a greater impact on stocks than before, rather than being dampened down. They're having a
Right.
greater impact than before, because more and more people are seeing the results. You're not having to wait 1 to 5 days for the Wall Street Journal to get around to writing about it.
Yeah.
You
don't have to go read your newspaper, call your stockbroker, and then have your stockbroker execute the orders. You can go on your Robinhood application on your phone, see an alert come up, and trade right then and there. So the information is so much more readily available to a much wider audience than it was before the revolution of the internet.
So you've got that article, and so what you did is you looked from 2011, then sort of tried to replicate some of their findings from 2011 to 2015.
Yep.
To see what were you looking for in terms of measures, and what was some of the specifics that you dug into?
So basically, my goal was to see if 2011 and through 2015 kind of followed the same pattern that they were finding in the study. Basically, they found that the volatility during earnings announcements were increasing at a growing rate, and it was more than twice the average daily volatility of securities for any other day on the year. And I did that same research for securities that had an earnings announcement from each of the years, and I found basically the same thing that they did, where volatility around earnings announcements, so the stock price, the daily percent change, it swung about twice as much as it would normally do on a daily basis.
Okay,
Yeah.
So can we walk through some of the
Yeah.
calculations? So you published this notebook here out on the forums, and so you walk through some of the stuff here, and then what was some of the sort of the math that you did? Like, let's walk through.
Yeah, sure. So first, you obviously have to go and get all the earnings announcements. We have data from EventVestor to do that, and you'll find out more about that with Anju. But basically, what I do is I look at a 5-day trailing window. Now, let me just skip to the graphs over here. So this is the first graph I made. I look at a 5-day trailing window from 5 days before the earnings announcement up till 5 days after the earnings announcement. And the first thing I look at is kind of a percent change, so cumulative returns starting from t-5 all the way to t+5. This graph isn't that interesting because each year has a different trend, and it's kind of like you plotted them all on the same graph, so you can't really see the effect as significantly. But you can notice that, especially for the red line at the top, you see that 1 day before, because we're using close to close, you see this kind of spike in the stock's price because of the earnings calls, like an average trend upwards, and that in quantitative finance is known as the post earnings announcement drift, where you see the stock's price move towards the direction of an earnings surprise. But what's more interesting is that after I found the average percent change, I looked at the daily volatility of stock prices during that same time. So you can see here, and this is just in a 5-day window, a 10-day window, T minus 5, T plus 5. You can see here that all the way up till the earnings announcement, the error bars or the standard deviation of percent changes hovered around 0.03, and that's pretty constant. Even the day after the announcement, that trend just kind of follows through. But on the day of, there's this kind of huge spike in the standard deviation and volatility, and that's on average about 0.06, 0.07. And I looked at that same trend, not just for that 10-day window, but I calculated that for each trading day of the year. And I did that for 2011 through 2015. And the results were pretty similar. We saw in the graph before that on a non-announcement date, the average standard deviation for percent change was about 0.03, and we see that here for the average daily change from 2011 to 2015. But if you look at the announcement date, it's basically twice of that throughout the different years.
So some of some of what Jess hypothesized and sort of discussed as sort of the theory, actually you saw in action with the price movements around the
Right.
earnings announcements. So there are jolts one way, there are jolts up and down, and those jolts tend to happen more frequently around an earnings announcement. Is that sort of the conclusion?
Yeah.
So with that in hand, how do you use that in an algorithm, say on Quantopian? Like, what are you going to do? How do you take that into account if you want to reduce the risk, reduce the volatility in your algorithm? On Quantopian, what are you going to do to make that to sort of impart that learnings on your algorithm?
Right. So people who haven't used Quantopian before, we have a backtester available for you to use. But if you are using the backtester, there's a couple ways of going about doing it. One is you can import your own data set and use that through Fetcher to create your own kind of risk avoidance model.
Sort of the old hard way.
The old hard way. We've made it a lot easier for you to do that, obviously. And we're doing it through the new pipeline API. So this notebook is published publicly, so you guys can go take a look at it. But I also published a framework to make it super easy for you, and it's using the new pipeline API. And so if you go load it up, there we have a custom factor built off of the earnings announcement data, which we're getting from EventVestor, which basically tells you the business days until the next earnings announcement for a security.
Okay.
And the business days that have passed since the last earnings date for a security. And Pipeline makes it super easy for you to just say, when you're starting your algorithm, let's screen every security with X days before an earnings announcement and X days afterwards an earnings announcement.
So let me unpack that a little bit. So EventVestor provides data. They provide data about the calendar data, when an earnings announcement is going to be for many stocks.
Yep.
And then Quantopian, we've provided not only we're taking that data and then in turn sort of reformatting and delivering that data as a factor to tell you how many days until the next earning. Like, there's 1 day until the next earnings announcement for Apple. There's 3 days until Google's announcement, and so on and so forth. So, and how many days you can also do how many days since the last announcement. So that way your algorithm can have warning. Is that accurate?
Yeah, more than a warning, it will avoid that stock entirely.
Okay.
Or you can choose to have it as a warning, which we have as an option for you to use. But the easier way is to just avoid that stock.
Gotcha. So
and not even put it in your tradable universe.
So let's just focus on risk for now. That actually brings up an interesting point about using it as a sort of an alpha or a signal to help deliver alpha potential to your algorithm. But just in terms of risk, you can use it to essentially exit out of any security or avoid entering into a security that's about to enter this typically more volatile period in its price movement. So how do you do that inside an algorithm? So you had that factor, you imported it, and then what do you do with it in pipeline?
So in pipeline, all you need to do is add that factor to your pipeline. So you're kind of saying, so I'll just walk through the whole flow for you. So first, I'm creating my pipeline. And for those who don't know what pipeline is, it's basically kind of a human math machine that's going to, you tell it a bunch of instructions of give me, hey, human math machine, give me these types of securities that meet this criteria. That's what pipeline is. You tell it a bunch of instructions and it gives you back a list of stocks.
It's a way to rank stocks based on different criteria. So in this case, we're adding a criteria of days until earnings announcement or something along those lines.
Yeah. So first, I'm creating my pipeline here, and down below, I'm adding the business days until next earnings and previous earnings factor to that pipeline. So this is the criteria that Josh was talking about. And then I'm actually telling pipeline to filter out any securities that don't meet the criteria that I've set. And the criteria in this case is if the business days until next earnings is less than 7, or the business days since the last earnings is less than 7, then don't bring the security into my universe.
Gotcha.
Well, I'm doing the opposite of saying only give me the securities that have an earnings announcement that's really far away from both previous and next.
Gotcha. So any algorithm that's say using this pipeline or not can use it to help sort of set and screen stocks in, screen stocks out based on this criteria. And this data is coming from EventVestor, right? So this is premium data on the site. But there's free sample data as well. Is that correct?
There is free sample data. It's about 7 years worth of free sample data.
Okay.
So it's a good chunk for you to test with if you're back testing any strategy within.
Gotcha. So on Quantopian, there's this concept of sort of premium data, sort of extra premium data from our partners. You can try. Every single partner has a free sample that you can try and backtest on, and then if you want to use it in real live trading, you need to purchase access to the premium version of it. Yeah. In this case, what's the price for this data set?
It's like $5.
$5 a month. $5 a month. So in this case, it's $5 a month. You can use this. Is it just in one algorithm, or you can use it in as many?
You can use it. I believe in as many algos as you want.
Cool, as many algos as you want. So just for sort of $5 a month if you're using it in live trading, if you want the most recent data.
Yeah. Just quickly before we move on, I just kind of want to show everyone how to get to that data.
Sure.
So we actually have a link at the top that says data. You click on it, and you in the search bar, you just want to put in earnings calendar. Sorry.
Yeah. There you go.
Click that, and I already got the free sample, but if I wasn't a Quantopian employee, you could easily hit a get free sample button that will be right here for you to start using that in your algorithms. And you need to do that before you can use the data.
Right. So if you don't do that, you get a usage not allowed.
Yeah, it's super annoying. Yeah.
You get usage not allowed. You need to come over to this page and give it a shot. All right. So let's check the question pane for any questions, and otherwise we'll make sure we didn't miss any big points here.
Where is the notebook? Can't find it. So George is asking where the notebook is. So if you go to our community page on Quantopian, it's going to be one of the top posts there right now. It's called Event Study, the Rising Impact of Earnings on Stock Returns. And we're also going to send out all the material that we've used in this webinar out as an email afterwards.
Awesome. Yeah. So there'll be a follow-up email. I think it comes from GoToWebinar. The GoToWebinar. It'll come from it comes back from Dan.
Yep.
It'll come from Dan Dunn, and it'll have links to some of these things like that sample algorithm, the notebook, and so forth.
Yep.
As well as that page.
Yep.
So we're about to sort of swing things over to Anju. And while Anju is sort of hitting the unmute button on his phone, hopefully, I will say feel free to throw in some questions. We'll ask Anju some questions, but if you have questions yourself, definitely throw them into the question pane, and we will get to them after Anju speaks. So Anju, are you there?
Josh, can you hear me?
Yep, we can hear you.
Great.
So Anju, this is one of, say, 25 data sets that you've got on Quantopian. Can you help us understand just sort of the process? Where does this data come from? How do you generate it? Where is it? Just to get sort of the underlying background to it.
Sure, Josh. So as you said, we collect extensively almost all the corporate events data, and we do have 25 plus data sets on Quantopian. And most of the data, including earnings calendar data, we collect it from the company websites, press releases, SEC filings, and company events pages. And the way it works is, sometimes these events are available months in advance. In some companies, it may be weeks in advance, and some companies do provide only days or a few days in advance. So we monitor continuously a team of our researchers and try to make it available as soon as it's available on any sites. And still, there is a small fraction of the companies, maybe like less than 5%, which don't explicitly provide the earnings calendar date. And in those cases, we try to estimate based on the historical trends. Usually, companies do like, third Wednesday after the fiscal period is over, or fourth Wednesday. So they do have some standard approaches. So we use that information in few cases where that's not available. And we do have the data from 2007 onwards.
So it's, I guess one question for me is like, how much of this is sort of science, right? How much of it is like automated scraping and collection versus how much of it is a little bit of art and sort of the human touch that you need to layer on top of it?
Okay, it's a hybrid. So we do use science to a great extent, and we try to parse some of the data where it's possible. And we also want to make sure that we know that how critical this information is, making sure we get the right data. In the case of earnings calendar, obviously it's just the dates and the timing. But with other events, we have hundreds of qualitative and quantitative data points. So most of the events do also go through our analyst process to make sure that we capture the right information. So in short, it's a hybrid process.
And Anju, sort of one question. Another question is sort of who's sort of the typical market for this? And Quantopian is not your only sort of channel or only set of customers reaching individuals. When you first started EventVestor, who are you targeting? Who do you deliver this data to typically?
So we have quite a few large hedge funds using the data sets. Several of our data sets, including the earnings calendar. Most of the times, systematic trading firms. And we also have corporations themselves using our data, and we also do event studies, like one of the event studies Seong shared. So we do event studies on dividends, buybacks, earnings for New York Stock Exchange, and we have a partnership with the exchange, and we work with most of the companies that are listed on the New York Stock Exchange as well.
Gotcha. Cool. So this is so with that, I think I'm going to sort of pull back over to the question and answer pane, try to answer some of the questions. It looks like we got only one question right now. So if you've got other questions, feel free to chime in. So one question is essentially why is it at $5 a month? And I will answer that. I think one of the things that we really want to see is widespread adoption of this to help folks in their algorithms. I think there's a place for this kind of sort of risk, this kind of data in a risk model in everybody's algorithm. For all your algorithms, it's kind of like a sort of a best practice. Take your vitamin, floss your teeth, take a shower every day, and incorporate earnings announcements in almost all your algorithms, unless you're trading on that activity. So we want to make it something that every Quantopian algorithm we see is using it, so that it's sort of a pervasive part of everybody's sort of personal template for what they're when they build an algorithm, especially say a long short algorithm. So are there other events? Let's see there. Let's see. We've got a question from Stefan.
I just wanted to add on to what Josh was saying in the first question. I think we're basically trying to get it as easy of a decision for you to make it, because it's so important, and we think it's such a helpful thing. There's so much benefit that you get from it, and we want to lower kind of the barrier of entry for people to start using institutional quality data sets like that. So.
Sure. So Stefan asks, are there other events other than earnings that impact equities in general, and to create volatility and have calendars? And I think the short answer is yes, right? There's there'll be I think stock buyback announcements is definitely one that I can think of off the top of my head. I recall seeing a chart of Chipotle recently, right? Chipotle's stock just took an absolute beating, and then it bounced back, and the bounce back is sort of correlated to their announcement of a buyback, and that's another type of announcement that EventVestor provides. I don't know, Anju, are there other sort of high volatility events that you think would be good for a risk model?
Sure, Josh, that's a good question. As I said, we do have quite a few other events which are quite volatile. For example, we also, in addition to earnings, share buybacks, which is one of the big ones, we also track guidance changes. For example, I think Jess mentioned in the beginning, so when companies change their guidance, either they can raise their guidance, or particularly when they lower their guidance, those are the events. Again, you see that stocks undergo quite some volatility. We also have M&A events, spin-offs, stocks, and activist events. Sometimes activists file 13D filings, and they produce volatility. So quite a few events. And I also want to add something more to the earnings calendar, Josh.
Sure.
So as Jess mentioned in the beginning, if you can't capitalize the information around earnings calendar, the best way is to avoid, like Seong built the model. But we are also releasing this month an extension to the earnings calendar we call earnings factors. We have several factors. What it shows is, does the company has any major events prior to earnings announcement, between the last earnings and this earnings announcement? For example, did it do a major acquisition, or is it being acquired by a different company? Is the company added to a major stock exchange? Does the company has a new CEO, or is it a new company? Is it whether through an IPO or through a spin-off, or did it spin off a new company? So we have about 15-20 factors that will give you indications on as you go into the earnings announcement, because these are the factors that determine the kind of volatility you could expect. So you could use this either for risk management or even as alpha signals.
Great.
And we also provide some additional insights on the earnings day based on our data collection, right? Not only just saying that the company will announce earnings on, say, this Monday, but we can also provide information on whether the company is also going to announce any guidance on that day. Again, this is all based on the historical information. Is the company going to announce or increase dividend? Is the company going to report any actual share buybacks? So these are some of the additional factors we can provide on the earnings day.
Gotcha. Awesome. So I think we are at the bottom of our list of questions here. So we don't have any other questions. If folks do have any, we got one. Will this webinar be available on demand? And yes, we have. Have we been recording, Seong?
Yeah.
We remembered to hit the record button.
I did.
So we will likely we will be after we leave here, we'll be transferring that recording off to YouTube, and you can look for that on the Quantopian YouTube channel.
Yep.
So Quantopian will post pretty much all of our webinars up to that YouTube channel, and you'll be able to replay it there. hopefully we'll likely also post links in the forum postings that mention this as well. So hopefully you'll get lots of access to both the raw algorithms notebooks and this recording.
Hey Josh, I had one other thought I could just chime in thinking
Sure.
about. First of all, that's list of events that Anju shared is awesome, and that's exciting that EventVestor has all that data. So I'm excited to see it continue to work its way in. So M&A was the first one I was thinking of. Also, I was thinking of product releases, which might have been one that I don't know if Anju mentioned. So like,
Yes, Jess, we do have product releases.
cool. Yeah. So I always think of, right, like when's the new iPhone coming out or the new I guess Apple Watch, excuse me. It's probably heresy to say iWatch. The other thing I was going to mention, just sort of from thinking of, like, if you're trying to think of how are you going to use events for an alpha strategy. So I think we've rightly focused a lot on the, using events as a risk management strategy to get out of the way of events that your strategy doesn't know about. One thing to think about if you'd like to design an event-driven strategy is that events, by their nature, happen sort of asynchronously across your potential investment universe. And so one thing that can be tricky is figuring out is the event you're thinking of that you think is going to move stock price, is it something that happens often enough that you can get a statistically significant set of historical data to build a strategy around it? And then does it happen often enough across a wide enough cross-section of companies that you can design a strategy that's going to be able to sort of manage its cash and its leverage efficiently? So, sometimes I'll hear people asking like, oh, hey, a lot of people get excited about trading, let's say, news events, right? So something will happen in the news that becomes a significant event for a company, and people will say, hey, what about times in the past when this type of thing has happened? I think we actually were talking with a reporter about an idea like this the other day around when Obama makes a speech about guns, what happens to gun companies, right? So one thing that can be tricky is making sure the event you're interested in, if you want to trade, a long, short, market neutral quant strategy that's really kind of sort of stat arb in nature, you want to be looking for events that happen, in a predictable way, which is sort of counterintuitive to the idea of events, but happen routinely across a large number of companies. That's what makes these earnings events such a great place to start, because once you start moving to things like M&A is really interesting and exciting, right? But you got to figure out how are you going to line up in time trading an M&A event signal. You've got to have a whole bunch of companies that are acquisition targets that you might want to be long, and then a whole bunch of companies that are potentially acquirers of big things that you might want to be short. And so it starts to become a challenge to compile together and sort of synchronize up big long short strategies around events that are kind of unpredictable in nature. So when you start to see people looking for, hey, how do I trade like news events? That stuff I think gets a lot more complicated, and you'll see a lot of the challenges in that area are where people are trying to understand how do I take all of this unstructured data and come to some understanding of trying to sort of normalize it and be able to give like a ranking score across a large number of stocks.
Yeah.
So that's something where earnings is really an easy kind of like training wheels version of events to start thinking about.
Cool. Yeah. If you want to go aggressive, Jess, there's always we've got a bunch of news sentiment, bunch of different sentiment data vendors loaded in. We've got news sentiment from Acern. We've got trader sentiment from Psych Signal. So you could easily combine multiple pipeline factors to maybe build your own model there, and build your own model just in Quantopian with all the data already loaded up and all the free samples. So we've got a couple other questions here. I think one question was sort of a blocking and tackling. How far back will these factors go? So each data set from different partners is different. In the case of EventVestor, their data goes back to 2007. So the free sample is from 2007 all the way to 2014, 2 years from today. And then the full premium set, which is for $5 a month, goes all the way up through to today. So from 2007 all the way to present day.
And it'll keep going
it
live.
gets
Yep.
updated, right? That premium set gets the live updates. And then Hal asks this next question here: Is there a reverse lookup functionality? For example, list all the stocks that have certain amount of volatility after an earnings announcements.
Yes, there is. It's super easy in Pipeline. The criteria stuff that we showed you previously on this webinar. What you can do is say, give me all the stocks with previous days since last previous business days until previous what is it? Previous business days since last earnings.
Right.
Is like less than 7. And then you do an extra filter on top of that and say stocks that fit that criteria and stocks with a volatility greater or less than whatever number that you were looking for.
It's a great sort of use of. It's actually a great use of the pipeline, right? You can use 2 factors. It's not sort of pre-built, but it's 2 factors, right? Another easy factor, built-in factor to use is the price for each equity.
Yep.
So you can look for sort of big discontinuities in the stocks, and sort of Boolean and with the stocks that just had an earnings announcements within the last couple of days.
Yep, exactly.
Okay.
That's what the pipeline was basically made for.
All right, so you can filter, you can sort of essentially layer on multiple factors to come up with the calculation.
Whatever combination that you want. Yep. And Simon is asking, can contest algos use the premium data sets for free?
Contest algos cannot currently use the premium data sets for free. We are brainstorming in that direction, but currently that's not the case. And we if you want to use this data in the contest, you need to forgo 2 lattes for the
One
for the
Starbucks
month.
latte. All right,
two. I think 2. I don't know. My wife gets iced coffee, so that's like $2.85.
Yeah.
So 2 iced coffees. If Simon strikes me as an iced coffee kind of guy. He's not a latte kind of guy. 2 iced coffees, and then you can use it each month in your contest algo. So no, you have to use that contest. Using the contest, you're required to pay the premium subscription.
And Josh, just thinking about that, I don't know if like we've successfully communicated this outwards, but for us, the reason we can't offer the data sets for free in the contest is really a scale issue. So these data sets have a cost associated with them, and you've done an amazing job negotiating retail rates for institutional quality data, which is always a huge win. And what the problem, so our data partners have generously agreed to usually make a good amount of backtesting data free. So what's cool about that is, there's no upfront cost to figuring out whether you think the data set's valuable or has alpha. But then, there's obviously a cost associated with, accumulating, building, and maintaining the data going forward. So really it just comes down to, who's going to eat that cost. For Quantopian to eat that cost for everybody submitting to the contest becomes prohibitive, and would basically just, be too much of a loss for us to incur. On a small scale, us covering data costs, for example, for algorithms that successfully make it into getting an allocation from, the prop fund, or maybe winning the contest, or getting into the fund that we launched down the road this year, like that'll obviously be something that we can subsidize and can take out of the returns that we see there, but it's sort of not a concept that we're looking to profit off of people coming into the contest. It's more just, is Quantopian able to subsidize at scale those data sales, and it would make the contest a lot more expensive, and probably prohibitively expensive, I think, given the targets we have for how aggressively we'd like to grow the contest submissions.
Yeah, exactly. I joke with our CEO and our finance guy that I could easily eat up the rest of our bank account with data purchases on behalf of our community. I think that would make Anju very happy, but unfortunately I can't bear these costs for us right now, or for the community right now. Any other questions? All right, I think that wraps it up here. So it's 2:56. We got you out of here inside the hour. We want to thank everyone for joining us. We'll send a follow-up email again with the recordings and the notebooks and the templates that Seong showed. I would and we're happy to answer questions in the forums or through support tickets as hopefully folks start to try to use this earnings announcement. Keep your eyes peeled. We'll be doing more webinars and rolling out access to more premium data sets in the coming weeks. So we've got Psych Signal that just hit the store, and we've got a couple others that are in the pipeline, so to speak. So thanks everyone, and we will talk to you soon.
Thanks, Josh.